Hey, hi everyone. Welcome to another video as a part of our option selling positional trading strategies adjustments series. So, today we are going to go through the adjustments that could be done for Batman positional trade in Indian index markets. So, we will go through some specific scenarios and examples from Nifty, Sensex, and Bank Nifty and each adjustment that could be done. Okay. So we're going to talk about Batman strategy and the adjustments for Batman strategy. Okay, and some specific examples from Nifty, Bank Nifty, and Sensex. So what is the Batman strategy? So Batman strategy is a combination of call ratio spread and a put ratio spread. When you deploy both of them, then it becomes a Batman strategy. Okay, it gives you a very high width, means huge width, and okay. So let's say what is the Batman strategy? It's a low cost, high reward strategy, and where you sell ATM options. So you'll sell the ATM option at the money options and buy two wings, deep OTM options on both sides to form a double hump. And this double hump profit curve looks like Batman's ears on the payoff chart. So yeah, so this entire series is the adjustment series. We have another Nifty backtesting series. So there I have covered all different strategies. So this is the Batman strategy, right? So if you deploy the Batman strategy, this is how it looks. Okay. So I that's why I'm not going through how the Batman strategy looks like and how you need to deploy and all that, because that is already covered as a part of backtest series. So these two hums are looks like Batman ears in the movie. Okay, that's why it's called Batman strategy. Uh, yeah. So you're selling two calls uh, at the money calls, and yeah, and you're selling two calls and two puts. You're selling, and at the same time you're buying one call and buying one call and one put. You're buying. So this is what is the Batman strategy. Okay, yeah. Let's go back. So just refer to that backtesting series thing everywhere, so that this and that series and this series, if you go through, that will help you a lot. Okay. So here a call put Batman strategy. They basically so this Batman strategy is a low cost, high reward strategy where you sell ATM options and buy two wings, deep OTM options on both sides to form a double hump profit curve that looks like Batman ears on the payoff chart. Okay. View is market will stay within a wide range. You'll get a very wide range. Okay, and especially when you take positional trade, you'll get a very wide range, like 3.5% or 4% on either sides. You'll get, okay, depending on the market again. So I'm talking about Nifty, but depending on the market, you will get a very huge range until expiry. And this is a low volatility outlook. So you're expecting that the market will stay within that wide range. So typical setup for a call put Batman is you'll sell one ATM call, one ATM put. Short straddle you'll sell. Then you'll buy two for OTM calls, one higher, one lower, and two for OTM puts, one lower and one higher for the same expiry. Advantage is high premium collection than an iron condor. So this collects high premium than an iron condor, and but it also protects you against the extreme moves. And risk is it has still has limited risk but larger range than a plain straddle. So it has a larger range than a straddle, and it will collect more premium than an iron condor, and it will protect you against extreme moves also. So that's a beauty of Batman strategy. It will let you capture a large range than a plain straddle, and will let you collect more premium than an iron condor, and it will protect you against extreme moves. So what are the different adjustments by scenario? So market stays in the middle within your range. Okay, so then near your ATM short strikes, then time decay will work in your favor, and both the short legs will make profit because of time decay. So you don't do anything once the profits reach 60 to 70% of maximum profits. You take those profits and leave the trade. Close early before event risk. Once you get the 60 to 70%, or you are in profit zone, exit the trade before any event risk happens, like RBI, Fed, or budget. Weeks. Exit with the capital with the profit that you have made. So the next scenario is market moves towards one wing, but still inside the break-even range. So it as long as it is inside the break-even range, you are going to make profit, right? So you'll be in profit, but you will be less comfortable because you will have that risk that it will break the range. But yeah, as long as it is within the range, you will be profitable. So if you feel like you are uncomfortable because there is a chance that the that it may break the wing, you roll that threatened leg, just move it a little bit so that you get some room. Okay, so roll the threatened side short leg. For example, Nifty is at 20,000, set up with short 20,000 CEP you have done, move to 20,200. Okay, so roll this 20,000 CE to 20,300 to give some more room. Or you can add calendar spread on the threat end side. So if C is being broken, then you can add a calendar spread, sell a near month option, and buy a next month strike of the same option. Okay, so that's what you could do. You could add a calendar spread to protect yourself on from break from the range breakout. But as long as it doesn't break, you will be profitable and you will make money. But this is these adjustments are just so that, if you feel uncomfortable, then you could do this, like you roll the short, whichever leg is being threatened, roll that. Or you can add a calendar spread on the threatened side. That's what you could do. Second thing is, or you could do one more thing. You could just don't do any adjustment. Just keep some stop loss in mind, and once that stop loss is that you exit. Or if you feel like it's uncomfortable and you're anxious, then do this. Then add a calendar spread on the threatened side, and add a or roll the short side threatened side leg. Market breaks out beyond the one of the wings, so then that is a problem. Then you will be in losses. And you could do multiple things there. You can add a debit spread on the threatened side. So whichever side breaks, suppose it breaks on the on your bullish side, so then you could add a call bull call spread there. And if it breaks on the bearish side, you can add a bear put spread there. Or you could just add just remove this entire batman and add a new batman with the new follow the market basically. Or you could deploy two batmans also, basically you could do that. Or you could just remove the existing batman, and that's what is the role entire structure. You move all the strikes to follow the market. Or if you feel like market is going to stay within a range after breaking, then you could convert it into an iron fly. So close that entire batman and just put an iron fly there. Okay. So these three things you could do. If market breaks your wings, you just remove the Batman, add a new Batman, follow the market. You add a debit spread on that threatened side. If it's the bullish side, go add a bull call spread. If it's the bearish side, add a bear put spread. Or if you uh, uh, want, you can add an iron fly also to keep only the threatened side hedged. So this you need to do adjustments because this has already broken the wing. Here you can wait, and when it's still in the range, you will be profitable. If you feel uncomfortable, then only you put the you either move the roll the threatened side, or add a calendar spread on the threatened side. Here also you could add a bull call spread or a bear put spread also here also. Yeah, so once it breaks, you, yeah, basically put a new Batman with the new following the market, or put a debit spread on the thread side, or convert it into an iron fly. Market makes extreme moves past bot wing strike. So if they're extreme rally, then yeah, you can't recover. Basically, you book the losses and redeploy for the next expiry. So that's what you could do. And once, if your view has changed now from range bound to either bullish or bearish, then take that trade. If the breakout is bullish, add a call ratio spread there, so that you can capitalize from the bullish movement. Or you can just add a call, just buy a call there. Similarly, if the breakout is bearish, you can buy a put there, or you can add a put ratio spread there. So these are the different things, adjustments that could be done for Batman. Batman is a very powerful strategy for option selling. Its probability of success is very very high. It gives you very high range. Okay, and premium collection is very high. It's one of the most popular strategies in the positional trading world. Okay, but yeah, again there are some risks to any strategy, and we need to do make adjustments when such scenarios arise. So practical examples are, you sold 20,000 CE and PE of Nifty, and you bought 19,500 PE and 19,200 PE. Okay, You sold 20,000 CE, then you bought 20,500 CE, 20,800 CE, and you bought 19,500 PE and 19,200 PE. Okay, so two ATM you sold short straddle, and then you are buying OTM hedges. If it stays within the range, just collect the profit. If it moves to 20,200, then roll the 20,200 CE to 20,300. If it jumps to 20,600, add a debit spread there. You buy a 20,600 CE and 20,000, sell it in 20,800 CE. It's a bull call spread basically. Same for Bank Nifty. So what you're doing is, if it's in range, make profit. If it's within the range but is trying to break also, just you will make profit. If it broke the range, then you add a on that particular side, um, you move along with the market, add a new batman, or you put a, debit spread, basically a bull call spread or a bear call spread based on the breakout. And if it completely breaks, your total rally is there, then they exit the trade and take the trade for the next expiry. Okay. So upper break-even point and lower break-even point are critical. Adjust before breaching them. So if it is trying to breach it, it's very near to breaching it, then do the adjustments. Okay, don't wait till it breaks. Avoid during very high IV events. Okay, like RBI events or that, then market can rally or fall. So such events are there, then you avoid this Batman. Premiums can drop sharply after event, hurting adjustments. Okay, so keep margin buffer. Batman involves multiple legs. So if you want to do adjustments, you need additional capital. So keep that buffer to do the adjustments. So that's the Batman strategy and the adjustments, guys. So that's it for today. Thanks everyone. Have a nice day. Bye.